are here to talk about opportunities beyond houses and holes on the ASX. Sounds pretty drab, doesn't it? Houses and holes. But if we have a look at what houses and holes mean, obviously houses relates to our banking sector, which the major banks that's become their mainstay in recent times. And obviously the holes are the mining sector. The 7 big companies, the iron ore and the 4 big banks make up about 34% of our index. And if we add in a few of the other top 20 players like Woodside and Macquarie Bank, we quickly get over 40%. So it does take up a big slab of our market. What we're going to try and do here this afternoon is actually look at the other 60% if we can and see what's there and what the experts are looking at. So welcome Phil, Tim, Matt and Mark. Lovely to have you along. Great panel, one of the best we've ever had. Now, the first question we're going to go down, we're going to start like we did in the last one. We're going to start big and we're going to work our way back to more specific stuff. And the first question that we'd like to answer is, what's a simple one? What's the outlook for the Australian market and the returns into the near future? Phil, I'm going to kick off with you. You're sitting over there by yourself. It's like the old COVID days. You can move in a bit closer. A bit scared of Tim. Well, I think Phil, let's start with you now. I know you're normally bullish, but you're a little bit hesitant these days, and that revolves around bonds and US bonds in particular.
Yeah, look, one thing I've always watched very closely is the long bond, the 10-year in the US, and I think that's what equities get priced off. There's always a lot of noise. The brokers love to talk about the next rate rise and all that, but I think it's the long end of the curve that drives stock markets. And so I did scare someone in my office recently because I did say that, you know, the rise in the bond yield for the US is worrying me. I think yields are threatening to break out again. And I think it was the collapse in bond yields that drove the bull market for 10 years. I think it was when bond yields started going up as a result of rising inflation that we had the bear market. And in my view, you know, bond yields have basically been in a trading range for 12 months. And now they look like they might be breaking out, which I think makes me very cautious on the outlook of the US market. But having said that, I still think there's tremendous opportunities in both the US market and Australia. As we all know, a lot of the rally has been driven by the Magnificent Seven. And I think below the surface, equity returns have been quite low. And I think valuations are quite attractive. And that's both in Australia, which hasn't had such a run at the top end, but still has many opportunities below the top end, and the US. So I'm positive, Matthew, but positive more on active managers rather than passive.
We can come to that a bit later, and that's a very good point. What number on that US 10-year bond yield makes you very nervous?
Oh, you didn't tell me you're going to ask me that. But I think we saw highs last year of 4.4%, 4.3%. So I think if we go through those recent highs, we'll be looking at probably the highest bond yields in 20 or 30 years, and that would make me very nervous.
We'll switch over to you, Mark. Things might look a little bit better down in Melbourne, where you've come from today, so thanks for joining us. Your view is we've just been through a reporting season, and you're not that excited by the overall market in Australia. Valuations don't excite you. Is that a fair comment?
Since November last year, the ASX 200 is basically flat over that 10-month period. And unfortunately, Phil and I are going to sort of depress the crowd. We also think the market's going nowhere. And hopefully for us, it'll be a good opportunity for stock pickers to really find those opportunities where there's a company-specific angle. What we're finding at the moment is even though the market overall looks pretty fairly valued, defensive stocks look incredibly crowded and expensive. So there's parts of the healthcare space, part of the staples that you can understand why people want to hide in these stocks because you don't have as much macro sensitivity, but we feel that they're very crowded and trading way above historical averages. So they're at about the 96th or 91st percentile, depending on which measure you want to look at. If you look at low PE stocks, which is what we think looks incredibly attractive, they're trading at the 7th percentile in terms of how expensive they are versus their 10-year average. They've almost never traded this cheap. So even though you've got a market that overall looks broadly okay, we think there's fantastic sort of stock-specific and sector opportunities.
Thanks, Zach. Matt, we'll go to you. You've just seen through a reporting season as well. You're not too excited about the overall market. They're like the other guys. There's trepidation but you're more through the numbers that you've just seen and where we're at in the cycle.
It's amazingly resilient. Yeah, it's been so resilient, the Australian economy and the market. I mean, if someone 12 months ago, 18 months ago had said, we're in the face of 12 interest rate hikes in a row and that the market would be up double digit, 14% or whatever it did for the 12 months, you would have said they're mad. So that just shows you how hard it is to pick markets, right? 12, 18 months ago, you would never have bought a retail stock at all. And in fact, if you were buying, people would have told you were an absolute idiot. But they were one of the best performing sectors and some of the best performing stocks over the 12 months. So look, outlook's hard. But look, it certainly does get tougher from here, I think, both in the economy and then who knows for the market, but probably because we've been so resilient. The economy gets harder because the revenue line's been very resilient. The costs have been going up. The costs are going to keep going up, and that revenue line's probably going to come back down a bit. So pressure at the middle, pressure on profits. So that's sort of my best get.
So interest rates are going to hit that revenue line before they get the costs under control.
Yeah, that and then the interest rates are also still finding their way through the interest expense line. So we saw that probably was the biggest surprise in the reporting season was just that the interest expense went up a bit quicker than what most people were forecasting, but that's still going to feed through. So look, that's the best guess. I'm usually generally feel very optimistic. It pays to be an optimist, I think, as an investor. It doesn't pay to be bearish overall. We know which way the market goes over time, but I think in the next 6 to 12 months, things are looking a little bit tougher.
Okay, Tim, this is your chance to shine. You might be a dissenting voice here. And you'll probably have a longer term view on it. We might, while you're speaking, put a chart up about the long-term returns of Australia, which has been a fabulous market over the century. But you've got a slightly different longer-term view that there is great opportunity through a cycle.
Factors that were at play over that 100-year period are more pronounced now than they were. That's a period in which we've outperformed the US by nearly 2% per annum. And if you think about those factors, we've got a stable democracy, which is becoming increasingly unusual. We've got rule of law. We've got private property ownership. They're wonderful factors for capital formation. We've got a strongly growing population, which is very unusual for a developed economy, where our population growth at the moment is likely to exceed 2% and probably sit around that number for some time, which is a lot higher than the US at 60 basis points, and Europe and many other developed countries are actually close to going backwards. And then we've got an enormous resource base that we're fortunate enough is spread over a very small number of people. And that is the reality, whether it's soft or hard commodities, that is to our collective benefit. And we sit proximate to 3 billion people, many of whom are going to move into the middle class over the next 20 to 30 years. It's very easy to sit there and get worried about whatever's happening in the next 6, 12, 18 months. But the reality is the outlook for the domestic economy and as a result, the stock market is strong. And it's dangerous to get too caught up in what you think are concerns on a short-term horizon. As Matt said eloquently, who would have expected the market to rise in a period in which we had 12 rate rises in 14 months?
Well, I look forward to the Australian market resuming its outperformance of the US because it's been a few years, but we do look forward to it. One of the reasons and one of the key factors in Australia's performance over especially the last couple of decades, has been the emergence of China and the influence China's had, especially with our resources. As we know, China was laid out of COVID. It came out with a bit of a boom. Everyone got out very quickly, but since then, since earlier in the calendar year, it's been incredibly disappointing. It hasn't kicked on, and that in the market, in the eyes of investors around the world, that reflects on Australia. Mark, maybe go over to you. That the troubles China's having, and it seems pretty endemic around their property and youth unemployment. There's a whole bunch of things they've got to fix there. Do you think it reflects badly on Australia, and is it going to be difficult for Australia to perform in that scenario?
If the Chinese economy is weak, you tend to see a weak Aussie dollar, and obviously a weak Aussie dollar tends to mean more inflation pressure. More inflation pressure means the RBA has to be tighter on monetary policy. So there's these indirect effects that people don't think about day to day on housing or on retail spending, which are obviously very linked to monetary policy. The other thing is China is by far our number one trade partner. It's not even close who number two is. And it's also the biggest contributor to global GDP growth. So if you want to get a barometer for how global GDP growth is going, it's not going to be Japan, it's not going to be Europe, The US is barely going to grow over the next couple of years. So China's still critical.
Phil, you're probably a little bit more pointed than that. You're worried about the iron ore market, which is obviously what we're talking about, houses and holes, big part of that. Iron ore is held up incredibly well, despite all the troubles in China. We know they're the big buyer of the product. You got any views on that, and does it correct in the future? Chinese property is a bigger bubble than Bitcoin, and I certainly think it's going to take many years for that to unwind. And in fact, there's lots of similarities between what we're seeing today in China and we saw what we saw in Japan 30 years ago, and Japan has obviously had huge growth challenges for that last 30 years or so. And those similarities are things like an ageing population and a bursting property bubble, and also, I think, too much debt. So, I think there is a case to be made to be quite concerned about the outlook for China for the next 10 or 20 years. On the other hand, I think there's lots of differences between China today and Japan 30 years ago. And some of those differences are things like we just haven't seen the bubble in Chinese stocks that we saw in Japanese stocks. A lot of the debt in China is not in listed equities, it's in local governments. And so I think there's a very good case that the problems we see in China today won't be as bad as what we saw in Japan 30 years ago. But there's no doubt there's some serious challenges for China at the moment. And we think the Chinese property sector is going to be one of the biggest challenges for the next few years. And that's obviously got to weigh on iron ore. And so we, to be honest, can't quite explain the strength in the iron ore price at the moment. But I think it's very, very bullish for all commodities. The fact that in this rising inflation environment with rising cost curves, the commodities are holding up so well despite one of the strongest growing economies having such challenges. And so it does make us more bullish than ever on commodities.
And iron ore is under pressure. Can we pivot somewhere else? Can we find that growth, that lucky country where we seem to stumble onto things? Is there something that could replace iron ore as one of our major exports?
To the same extent, but obviously we should be at the forefront of the green energy revolution, because we have a lot of those key commodities in abundance and we're very, very good at getting them into production. I wholeheartedly agree with Phil, and I think we might have a slide or two, but if you look at Chinese steel production against all of the other largest steel producers in the world, that puts it into context. So when someone tells you that India is relevant in the number 2 position, they're not. China have been over-consuming for such a long period. If we go to the next slide, their consumption on a per-person basis, which is what this is on the y-axis, and you can see GDP per person on the x-axis, is quite extraordinary, and it hasn't followed a path that we've seen before. And like Phil, we're flabbergasted that iron ore is holding up, because steel consumption on a per-person basis peaked in 2020, and we expect that it's at the start of a very, very long descent. It got to a point that very few other countries have ever been, and the other countries have had an explanation for being there. To put it in context, Australia's never consumed more than 340 kilos per person per annum. China peaked at over 700 on a per-person basis, right? So there is a potentially very long descent. We're concerned with all of the things that Phil mentioned. And so it's important that we do transition. And the fortunate thing is we are already the largest producer of lithium in the world. We're already responsible for more than 50% of the global production of lithium. And we're going to increase our share because we're very, very good at getting commodities into production. And very few countries can say that. So as we transition to this green energy revolution, which is really unparalleled in its scope, it's like the Chinese boom in steel with every country on the planet. We need to make sure that we're really at the forefront of capitalising on that very, very considerable opportunity.
Matt, let's take that one step further. Miners and banks, houses and holes are a big part of our market. We can't avoid that. Should we actually embrace that scenario? Should we back our banks and our financial system and our miners and not worry about it too much?
Yeah, look, I think that, as Tim said, we are good at it. So let's be positive about the things we're good at. Because on this chart that I've got here, people, there's a lot of angst about that. A lot of people say, well, this is terrible. The market hasn't changed. You can see there, this is the breakup of the ASX 200 by the sectors, the banks and the miners, and we've been steady over the last 20 years, basically, of their share of the market. And okay, yeah, it'd be very nice. And as a fund manager, I'd love to have more choice, more industrial companies, some more different kind of technology companies to invest in. We just haven't had that, and that's a bit of a shame. And the major reason,
tag with a poor cousin a bit, given how strong technology's been in the US.
I think that we shouldn't undersell ourselves either. There's been some great companies come from Australia and being developed in Australia, and we know all their names. And Atlassian went off to the Nasdaq, and fair enough, I guess, for them. But there's plenty of great companies that have come up here. But what's happened over the last 20 years is that they used to probably would have come to the market, but the emergence of private capital, there's so much private capital out there, they just haven't needed to come to the listed market where we, obviously as fund managers, we'd like to see them. But, so going back, we're good at mining. Let's be good at it. We're good at banks. And financial services. Let's be great at that. And, and the test of that is that we've gone through a couple of crises in the financial system, globally, and Australia's sailed through pretty well. So let's put aside a Royal Commission. Yeah, put aside the Royal Commission. The financials have been, very well. So that's down to the regulation and down to the government as well. I'd give them credit for that.
Mark, you're not so bullish on our banks. We're going to put a bit of colour around that, but you're not completely pessimistic about the finance area of the world either.
Yeah, I'm sure a lot of people in the room have made a lot of money in the banks over the last 30 years. But the issue is that the best years for the banks were the last 30 years. The fact that we never had a recession, the fact that credit growth was really strong, interest rates were going from 8% to zero, bad years. I might start betting. If that's better for everyone, volume might help. In terms of the banks, the reason we're cautious is that we think that the last 30 years have really been the best years for the banks. Essentially, what you've seen over that period is interest rates falling from 18% to zero, which have inflated property values, which have enabled people to take on a lot more debt because they could service a mortgage much better at 2% rates than 18, obviously. Bad debts have fallen from very elevated levels 30 years ago to basically zero today. All of the cost out story has largely been completed, and now the banks are struggling to have flat cost growth, which a lot of their their financial objectives were targeting. But that's difficult when you employ 30,000 people and minimum wage is going up by 6%. It's hard to have flat costs. So what we think is if you want to play the financials, it's now actually the right time to switch into insurers, where you're seeing much stronger top line growth, you're seeing much stronger margin expansion. If you look at a stock like QBE, that's trading on a P of 8.5, you'll be getting, we think, a 6% dividend yield. And that stacks up really well compared to, say, Commonwealth Bank, which is on 17 times and giving you a much lower dividend yield. That's, I guess, a high level on financials. In terms of the miners, I share some of Phil's concerns on the iron ore price long term. I think, in the short term, I can see why we think iron ore is going to be strong because China, we think, is about to do some stimulus. We think some of the metals traders in that space tend to be very good at preempting government policy remarkably accurately. And we think that essentially what you're likely to see is this massive increase in demand that's coming from this shift to sustainability in electric vehicles and solar farms and wind farms. The thing that all of these initiatives have in common is that they require a massive amount of commodities, usually copper, lithium, nickel, and it takes years and years to bring on these new mines. So we think you're going to see acute shortages in commodities like copper, which it's very difficult to play on the Aussie market. There's only one ASX 100 stock that's a pure copper play, that's Sandfire. But there's better ways to play that overseas. We've got some Canadian copper stocks that we think are really well placed.
Let's shake loose the banks and miners for a second. Look at the rest of that, 60% of the rest of the market. Bill, top 20s perform really well. We might put up the chart now about the difference in performance between the 200 and the small caps there over the last, 18 months or so, and you can see the top line streaked away and the poor old small caps have been left behind. You think that maybe the large caps, especially that top 20 that lead that charge, it's a bit of a crowded trade, and the opportunity going forward is in the smaller cap end of the market. Comes with a bit more risk, less liquidity, but that's where the valuation is.
100%, Matthew. I think there's been a lot of money flowing into the top 10 in Australia and the US, a lot of money flowing through things like passive investors, and you just got to look at that chart. The real opportunity as we see it is in the small cap sector. And, I think one of the reasons we like small caps, they lag the large caps, and so I think they're probably still got a bit of catch up to play. But also, I think there's much better opportunities in the small cap space at the moment. And the two areas we're really concentrated on are what we call global leaders in the small cap space and the resource sector. So we like global leaders because they have a huge addressable market. We think that a lot of them are moving from losses to profits. The profits aren't so affected by a weakening economy. The valuations aren't so affected by rising bond yields. And so for many of these global leaders in our portfolio, we think we can easily see 5 to 10x over the next few years on some of those. And then on the resource sector, I think we share Mark's views that we actually think there's a career-defining opportunity in resources at the moment. A lot of people build careers out of investing in banks and infrastructure. But like Mark, we think it's yesterday's trade, and we think there's a huge opportunity in resources generally and also small cap resources at the moment.
Tim, we're on a roll now. We're all got very positive as we talk on, which is normal in markets. Start bleak, end up positive. Now, you are generally optimistic, and you've said that earlier, but you think there's a whole bunch of companies that sit maybe slightly below the surface, not in that top 20, even top 50, but are leaders in their field regardless.
Yes.
And there's some pretty good opportunities. We might consider them mid-cap, some small. Do you want to elaborate on some of those that you see?
Yeah, there's great opportunities. I mean, across all of the different sectors. I mean, generally you'll get opportunities in the market at attractive valuations because people are either concerned about the entire market. There's something geopolitically or on the macroeconomic front that have people depressing share prices, or there's something at the sector level. At the moment, there's a lot of opportunities in retail because everyone's very, very focused on the effect of interest rates. So there's a lot of companies screening extremely attractively at that end of the market. Or there's a company-specific event that people are suddenly worried about an issue that was actually always there, but it's come into focus. And ResMed's probably a great example of that at the moment. But Australia does have some genuine leaders in a lot of fields. So, we own companies like Car Sales, which is a wonderful business and has major operations in Korea, the US and Brazil. In fact, my deputy is currently in Brazil looking at their Brazilian operations. We have Breville in the portfolio, which again is a leader in small appliances. I mean, they are doing things that are absolutely changing the landscape within that industry. And sometimes with your Australian hat on, not realising what's happening in other markets, we don't realise just how good these companies are. So there are always opportunities. I'm reminded of Grantham's opening comment that quality is always underrated. So we tend to own the market leaders in each of the industries or subsectors within the domestic market because their ability to surprise on the upside is consistent and extraordinary.
Matt, you've got something similar. If we're going to go outside those miners and banks, you like a story that has got global ambitions and been able to execute.
Yeah.
There's a few names that you mentioned to me. Yeah. Pens are poised. Do you happy to share them?
Yeah. Look, I'm always happy to push my positions that are in the portfolio once I'm set. There's a famous thing as a fund manager, you buy and then you promote. And so this is promotion.
Is it?
That's the key. So look, as Tim mentioned, Australia has some great leading businesses. We do. We just don't have enough of them listed. That's what my point earlier. But the company I particularly like, I like two companies that are trading near 52-week highs, and I like two companies that are near 52-week lows. And very briefly, James Hardie, everyone knows who it is. Great Australian success story. It was on, it was all over this time 12 months ago. It was over. US housing market, forget it. And the stock's nearly doubled off that low. It's a great medium-term story. Put it in the bottom drawer. News Corp, I think, is another one at near 52-week high. I think the management team is starting to do some positive things. There's always people who criticise it, around the Murdochs, but we're not going to argue about that.
Rupert is getting old, maybe.
Mate, he's still looking for wife number 5. So he's doing all right for 92. So News Corp, I think it can grow. And so then those two stocks trading near 52-week lows. EBOS, a fantastic fly under the sort of radar company. It's in pharmaceuticals, it's in healthcare distribution, and in pet food. And then last one, Tim just mentioned it, ResMed. I don't think there's an Aussie fund manager who's not probably buying ResMed It's not often you get to buy a company of that quality, of that size, that's off 30% in in the space of a month. So they're my picks of the day. Ask me to borrow. They might be totally. I might I'll be selling. I might be selling all of that. So just be a bit careful.
If you start taking your diabetic diet pill,
What are you suggesting?
no, nothing. But it might change the investment outlook. That's what's happened in the US with ResMed, as we know.
Yes.
Dietary pills have got the better of sleep apnea. Let's move on to our next subject, which is an overcrowded trade. And that's always an interesting one because before you know it, you can easily be in an overcrowded trade because everyone's heard the story or got onto the theme. Mark, I've heard you a few times say publicly that because of where we've been in the last 12 months and because economies are slowing with interest rates going up, people have hid their investments in the most defensive, what are considered the most reliable investments. And, there's a bunch of sectors in that area. But you're of the opinion we've got to leave them alone. They're too expensive and they're crowded.
Sorry, I keep forgetting. There's two parts of the market that we think you should be trying to avoid, and they're the two parts of the market that emotionally everyone wants to fall in love with and feels very safe in, and that's the defensives, which I spoke about before, which we think are incredibly crowded and expensive, and it's not a safe investment if everyone's priced it like the stock's perfect. These companies are not perfect. They're just companies, and they have their issues and company-specific problems from time to time. We've seen that just in reporting season with the healthcare sector. I think the vast majority of healthcare stocks had a downgrade to earnings and a downgrade to outlook. Coles, which operates in very safe industry, supermarkets had a difficult period. Share prices come off. So these companies are not bulletproof, and they're priced to perfection. They're trading at basically the highest levels they've traded in the last decade. The other part of the market that I'd be pretty wary of is the high PE stocks. And the reason they're so loved, these companies, is because they're selling a sexy story. They've got a high growth business, but the shares are trading at the highest PE that they've traded at in the last 30 years. So if you take a list of all the ASX 300 stocks, you rank them from highest to lowest, you take the 25th percentile, so the median high PE stock, it's trading at the highest PE it's ever traded at in the last 30 years. It's even slightly higher than the dot-com boom. So this part of the market is that was a period of absolute insanity, the dot-com boom. We obviously had the dot-com crash shortly after that. We're at the same levels today. So anyone who tells you that, these stocks are fairly priced and they're not so overvalued, just go to our presentation. You can see that chart. The data is clear as day.
18 months ago, every market strategist 18 months ago said, buy Defence, buy Woolworths, buy Coles, buy Telstra, and buy healthcare. Not when I say every market strategist, bar one or two.
Majority.
The majority. And they said, buy that and don't, sell all your retail. And so again, the defensives have been the worst, and healthcare have been the worst performing sectors almost in the last 12, 14 months. So yeah, it goes to show that, go against the herd sometimes.
Go against the crowd. It doesn't always work, but it's got a pretty good strike record. Phil, you touched on it before about you think there's a crowded trade in the top end of the market in Australia. In those top 20, you obviously quite positive on the outlook for small caps. Now, my only concern is that Regal these days is quite large and that you could crowd out a small cap trade on your own. But besides that, you think that's where you've got to be brave and to move down that. I know we talked about it a bit earlier, but that's where you think the returns are. And you might find some names for us that you think are quite interesting at that bottom end of the market, or smaller cap, I shouldn't say bottom.
Yeah, I agree, Matthew. I think there is a bit of a bubble in passive investing. I think we discussed this the other day. I think you think it's structural, what we've seen, the growth in passive funds, and that, to be honest, I was thinking about it afterwards, and I think, yes, I'm glad he disagrees, because that gives me a lot more confidence. It was when people started saying that the mining cycle was stronger.
I wondered what you thought when you spoke to me. It's obviously the opposite.
Yeah. When people said the mining cycle was stronger forever, that was kind of the top. When people like Matthew Kidman say that passive investors are going to be strong forever, that kind of means that we're getting close to the top, I think.
I just wanted to make you feel better. That was
yeah. So I think there's obviously a lot of things in markets move in cycles, and I think the balance between passive investing and active investing is cyclical. And obviously, when there's a lot of active investors, you don't need them because markets are quite efficient. And so then all the money goes into passive. And I think that's what we've seen over the last 10 years, and that's probably been helped a bit in Australia by the growth in industry funds. But then when there's too much money in passive, then the opportunities arrive for active. And that's what I think we're seeing at the moment. We're seeing, there's some stocks joining the ASX 200 this year, and I think they're up about 66% in the last 12 months. And the stocks that are exiting the ASX 200 are down something similar. And I don't think those sort of moves are explained by fundamentals. I think Airbnb, which has joined the S&P 500 this week, has doubled this year. And I think that's not explained by the changes in Airbnb's fundamentals. So I think there is a bubble in passive investing at the moment. I think that's great for active managers. And as a result, one of the areas that we like hunting in at the moment is those stocks just before they start to join the ASX indices and other indices. Because often you find it's a domino effect. Once you join one index, then you kind of get the buying, a bit of positive share price performance, and you start joining other indices as well. And so that's a very happy hunting ground for us. And we own lots of stocks, global leaders, as I call them, that have got, huge runway ahead of them. And that's stocks like Satire, Chrysos, stocks like Life360, stocks like Audinate, Fineos. So Australia's got some really good companies, but they're just not as overpriced as the US.
At this point. Well, I feel maybe I should use you as my counsellor. I feel like I've got a job a bit longer now. So thanks for that. Tim, you might surprise people because I've heard you say a few times in various public forums that the crowd's not always wrong. The crowd can be right. I agree with Matt, 8 times out of 10 it's wrong, but it can be right. But an interesting one which makes you think twice now is the lithium market. You told us about that earlier and the great long-term prospects and one of the great drivers for the whole country going forward. But is lithium a crowded trade at the moment? We've seen the price come off. Very volatile creature in these early stages of its development.
And someone asked me recently whether it was a crowded trade, and it probably is. You'll be hard-pressed to find a fund manager that doesn't understand that demand is likely to outstrip supply for some time. I think we have a couple of slides on this. But if you look at what's happening at the moment with the electrification of the global vehicle fleet, it's quite extraordinary. And for those that think that we're not going to get to 100% EV penetration, well, Norway's at nearly 90 already. So in Australia, which you probably can't even see right down the bottom of that chart, yes, we've barely scratched the surface. But this is a trend that's going to continue for some time. If we go to the next slide, even Norway, in terms of how many of their vehicles in the entire car park, that is the entire pool of cars operating in the country, electric vehicles, it's still a very small number. And we've got governments around the world that are actively encouraging the adoption of EV-friendly policies. And many have mandated that the outlawing of traditional vehicles in the not-too-distant future. So this is a trend that the crowd can be right. This probably is a crowded trade, which means you'll get more volatility in the individual stocks than you might otherwise expect. But crowded trades can work. And I'm reminded a little bit of the coal seam gas boom that we saw immediately in the aftermath of the GFC. And because of the demand for those resources, basically every asset that was worth its salt got taken out by a global major. The lithium industry to date in Australia feels very similar to that. I suspect most of the juniors that have a decent resource will get taken out. You can play it safely in the large guys, the Mineral Resources and the Pilbars of the world, because, take Pilbara as an example, they have billions of dollars on their balance sheet. They've got a globally significant tier one asset. They're going to be producing for the next 100 plus years, and they're going to be increasing their production significantly over the next 4 or 5 years. So crowded trades can work. You've just got to be mindful of the fact that they are crowded and that you probably will get significant periods of volatility. So try to take advantage of it.
Follow up on that. You've just mentioned some names of some big companies now. They've come out of nowhere.
Yes.
And talking about opportunity in Australia. Mineral Resources has been around for a long time, but grown exponentially almost.
Yes.
And Pilbara and a few others, all came. But if we just said right now, they've come off in price quite a bit recently, volatile trade.
Yes.
Maybe do we just sit and watch for a little bit and the opportunity will arise because of that structural, we don't need to be too anxious about jumping into that at the moment?
Yeah, I think the way we think about it is we have a position size that reflects the fact that there is falling lithium prices at the moment. There's a short-term oversupply, particularly of batteries within China, which is the major producer of batteries. But even at a lithium price that's almost half of what it is today, you get a valuation well north of where the current share price is. So what would make us increase our position size? Well, if we saw a stabilisation in that price and a resumption of the upward trend in price that we expect to see over time as the excess supply of battery materials gets soaked up and the demand equation continues to kick in. So I think there's stocks that you want to have on your radar. Be mindful of the fact that you'll get excess volatility and try not to get spooked out after they've had a significant downdraft.
Okay, thanks for that. Now, we asked the guests to bring a compelling idea outside the banks and miners, but I might just go through them because I think everyone's said their stock except for one person on the panel, and we'll put him under pressure in a second. Matt picked James Hardie. He's told us very clearly why that's the case. Phil had Satire. Got anything to add, Phil?
I think it's a global leader in luxury fashion, online retailer. Very exciting.
Tim gave us Nick Scali.
Yes, you could buy the stock, but I'd prefer if you bought the couches. It's the only stock that we're aware of in the entire Aussie market that has a 10-year return on equity of north of 50%. So they go and invest $1 million, they make $500,000 a year in net profit after tax on that $1 million investment. That is an extraordinary record. What's more extraordinary is that they've done it virtually ungeared since they listed back in the mid-2000s. So this is a company with a huge rollout opportunity. They took out Plush about a year and a half ago now. That's been a very, very significant event for them. They're looking at more domestic and international acquisition opportunities. They've got a pristine balance sheet, and everyone's obviously very bearish on the retail category more broadly. So you're getting an opportunity to buy this on a single digit PE.
Okay, you can work out who didn't give us one. Mark, have you got a stock for us? You've only got 1 minute because we're going to go to questions in the audience. I can see Ali's hovering as well. So I'm not sure, but we've got to go to questions. But you give us your stock first.
Global stock. I've picked a global stock. The company's called CRH. It's listed in Ireland. So going back to Phil's comment about not getting much support from index inclusion, the Irish stock market's not exactly the S&P 500. And the company trades on a P of 12. It's the biggest building and structural materials company in the US. So you might have heard of Martin Marietta, which trades at 25 times, or Vulcan Materials, which trades at 30 times. Well, CRH is the number one player, and it's the biggest paver of roads in the US, and it trades on a P of 12. The Inflation Reduction Act is going to cause a 50% increase in spending on roads and bridges for infrastructure in America. They are by far the biggest beneficiary of that. So you're getting an 8% free cash flow yield, P of 12. They're about to re-domicile their listing to the US, and we think that's going to put it on the radar for US fund managers and for index inclusion. And we can see a huge catalyst over the next couple of years.
There you go, Matt. That's the key to funds management, a concise stock selection. Yeah, we've redefined it. I might end it there and say thank you to our panelists. Did you want to do the vote? Or are we over that? Yeah, we've got to get off. Okay, so thanks. Thanks, Mark. Thanks, Matt.
Thanks.
Tim,
Thanks,
Phil. It was fantastic. Big round of applause to everyone. Thanks, Carl.